Hey, the really big news in this past week has been that the IRS released Form 1099-DA. DA stands for digital assets. As you may know, a 1099 form is the vehicle that companies use to report to the IRS and to you financial activities over the past year. Now, in 2021, there were changes made to the tax law to require the reporting of broker-dealer transactions regarding digital assets. Digital assets is the new word at the IRS for cryptocurrencies. It took the IRS a long time to come up with comprehensive rules. They came out with a draft or proposed versions in August of 2023. People had opportunity to comment. They had literally tens of thousands of responses to these proposed regulations. And since then, we had expected to see within a month or two those regulations become formal, but they haven't. Now, these regulations that were released in August were detailed and well thought out and comprehensive, a little too comprehensive, perhaps, but one of the key elements is the form by which the broker dealers would respond to the government with information about your transactions. Well, that finally came out here this week. Now, I have it here. You can find it on irs.gov/form 1099-DA or draft DA. Can you see that? Oh, you can see that. Yeah, it has big lines over it. So it's not really exciting to read. Hey, look, very similar to the 1099-B if you're familiar with broker transactions. One of these forms gets issued for every single trade you make. Now, you have to report the mundane things like who bought it, who did you sell it from, all right? So who's the recipient, who was the other person, the counterparty. Then you also got to state what did you buy it for, what did you sell it for, when did you buy it, when did you sell it. And you have to indicate a couple other interesting things. One is on line 1I, if wash sales were involved. Wash sales. Wait a second. This is not a part of the law, but it's a part of the form. Guess what? The Biden 2025 budget says that we should start taxing wash sales on cryptocurrencies. Wash sales come in if you sell an asset of a certain type, let's say, Ethereum, and then you buy it back within 30 days before or after that date, you're deprived of any losses. That's a wash sale. What's also interesting here is that if you do an exchange, if it's not for cash, you do an exchange for something else, you have to indicate what that other thing was you got. So if you exchange one coin for another coin, the received coin is going to be indicated here in this form. What's really scary, and you're not going to hear this anywhere else because most people are going to react to that basic stuff. What's really scary is line 11B and line 12B. These are the digital asset addresses from which the transaction happened. So what address was the asset sold from? And then secondly, from what address was the asset transferred in? We're talking blockchain addresses. What does that mean? That means that when the custodian reports this transaction to the US government, they're going to report your wallet addresses. So let's repackage this information. So you have a ledger. On your ledger, you have, pick your favorite coin, Ethereum. You now decide to sell some of that Ethereum. You transfer it to Coinbase or maybe Kraken, and then you trade it for cash. Or let's say you just trade it for USDC, which you later transfer for cash. All right. Both those trades are reported to the US government. And the first trade is going to report the digital asset of your ledger. Let's say you have an account on KuCoin and you keep a lot of your assets there and you decide to transfer one over to Coinbase to cash out. Coinbase will have to report the address of the KuCoin account that you're using. Let's say you have multiple ledgers for various reasons, especially if you're, have a lot of assets. Your Coinbase is going to report the addresses from which things are received. So what does the IRS do with that? And this is very important. I've mentioned this many times. The IRS is working with crypto analytic firms like Chainalysis, like Elliptical. There's actually a race on to develop these applications. But they want to take an individual's assets as identified by their addresses and reconstruct the movement of their wealth in and out of those addresses. So what we're looking at is trying to create a picture of where all your wallets are, where all your exchange addresses are, and then at any given point in time, the IRS would be in a position to identify whether or not you sold any of those assets or liquidated them at any given time. So what does this give the IRS the ability to do? The ability to come after people who are not reporting their cryptocurrencies. So if you're a person who's not been reporting your assets, not reporting all your cryptocurrency assets, when this form goes into effect, which will be next year, 2025, they're going to start disclosing your assets to the IRS. The days of hiding are disappearing. Let's say you use an address, a MetaMask wallet, and you use that MetaMask wallet with a non-US based DeFi exchange. And I say non-US based, you might be irked at that, but like, for example, Uniswap would be considered a broker-dealer under US laws and required to report these things if you're on Uniswap. Now, so let's say we're non-US swaps. You've done a lot of trades on this MetaMask wallet, and then you transfer from that MetaMask wallet over to a US-based DeFi or CeFi exchange. They will disclose those addresses to the US government as a part of this reporting obligation. The days of hiding are becoming tougher, and the US government tends to be a thought leader in the regulatory fields and financial. So once the US government implements this, rest assured other governments, starting with OECD governments, will start implementing similar reporting and sharing information. The days of hiding are disappearing, and it's going to be very key because they can use this information not just on years going forward, but they can use it on years going back to see when people have not been reporting all their income and trading activity on their tax returns. If this causes you any concern, by all means, give us a call. You can go to Crypto Tax Audit, and we can talk through your situation, how to move you into a position where you are in compliance and do it in a sensible and sane way. And remember, go out there, make lots of money with crypto, pay your taxes, and then make lots more money.
Thank you very much for listening to today's show, and I hope you enjoy it. Please give us comments. We would love to respond to any questions you give us. If you have tax questions that we can apply to, we will try to address it in future shows. Please hit like, subscribe, follow. Thank you. Have a great day.
The Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton is one of the top experts in crypto taxation in the US. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. This show is sponsored by CryptoTaxAudit.com, the income tax experts for US crypto investors. Go to CryptoTaxAudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.